sophisticated, investigative, calm, and slightly noir. If you walk down Wall Street today, you'll see the giant logos of the banks you know: J.P. Morgan, Goldman Sachs, Morgan Stanley. They look like the kings of the world. But there is a new power rising. It doesn't have its name on a stadium. It doesn't have a retail branch on your corner. It lives in the shadows of private equity firms, names like Apollo, Blackstone, and HPS. This is the world of private credit. In the last decade, this industry has exploded from a niche corner of finance into a $1.7 trillion behemoth. It is currently replacing the traditional banking system as we know it. The banks are no longer the primary lenders to the companies that run your life. Private funds are, and they are doing it with less regulation, higher interest rates, and more secrecy than anything we've seen since 2008. Today, we are going inside. We are going to see how $100 from a pension fund becomes a high-interest lifeline for a struggling tech company, why Wall Street is terrified of this shadow system, and why June 2026 is the date when this bubble might finally meet its pin. To understand private credit, you have to understand why the banks stopped lending. After the 2008 crash, regulators tightened the leash on big banks. They told them, you can't take big risks anymore. This left a massive hole in the economy. Companies still needed to borrow billions, but the banks were too scared or too regulated to give it to them. Enter the direct lenders. The older brother note. Think of it like this. If you want a mortgage, you go to a bank. But if a company wants to buy out a competitor for $500 million, they don't go to the bank anymore. They go to a private credit fund. Why? Because private credit is fast, it's flexible, and most importantly, it's invisible. There is no public record of the loan. No one knows the interest rate except the lender and the borrower. We are living through the death of public markets. The most important deals in the world are now happening in rooms that don't exist on public maps. How does a private credit fund actually make money, and where does the money come from? It starts with institutional capital, your parents' pension funds, university endowments, insurance companies. In a world of low interest rates, these institutions were desperate for yield. They wanted their money to grow faster. Private credit offered them 12%, 15%, even 18% returns. The mechanics. Unlike a bank that holds your deposit, a private credit fund raises a war chest from investors. They then find middle market companies, the ones that are too big for a local bank but too small for a global bond offering, and they lend to them at floating interest rates. The catch: these loans are often senior secured. If the company fails, the private credit fund owns the building, the patents, and the chairs. They aren't just lenders, they are the owners in waiting. Everything works perfectly as long as interest rates are stable and the economy is growing, but we are no longer in that world. As we approach June 2026, the floating rate trap is snapping shut. Most of these private loans are tied to base rates. When the Federal Reserve raised rates, the interest payments for these companies doubled. The crisis of 2026. Thousands of mid-sized companies are now zombie companies. They are making just enough money to pay the interest, but not enough to pay back the loan. In the traditional world, we would see this in the news. We would see stock prices falling. But in private credit, it's all secret. The funds are called mark-to-model, which means they decide what their assets are worth. They can pretend everything is fine, right up until it isn't. This is the volatility suppression that is currently masking the true state of the economy. If the banks are being replaced, who is actually in charge? We are seeing the rise of a new financial aristocracy. Firms like Blackstone and Apollo are no longer just investment firms. They are the new central banks. They are funding the AI data centers. They are funding the hospitals. They are funding the transition to green energy. The power shift. When a bank lends you money, they are regulated by the government. When a private credit fund lends you money, they are regulated only by their contract. This is the ultimate form of digital leverage. They are using the world's data to find exactly where the friction is, and they are charging a tax to remove it. So where does this leave you? You might not be able to invest $10 million into an Apollo fund, but you need to understand that the safe world of the 20th century, where banks were the pillars of society, is gone. We are in the era of the shadow bank. If you're a student with $100, your goal is to build your own private credit mindset. You need to be the person who provides value where others see risk. You need to be the one who owns the systems, not the one who is owned by the debt. The 2026 pivot is coming. The invisible debt is piling up. The doors to the traditional banks are locking. If you're ready to look past the logos and see the real machine, comment "Shadow" below. The world is changing. Don't be a passenger. Hit the like button. Don't forget to subscribe. I'll see you in the next one.